Hi, good day, mates. It's Adam Khoo, broadcasting from beautiful Tasmania. So, yesterday markets took us on a wild ride. We started really bearish, gapping down at the open, and then ending up the day really bullish. So, are we near a market bottom? Let's find out in this video. Right, hi guys. So I'd like to talk about what happened to the markets yesterday, because I think what happened, if you look at the price action, is pretty significant and doesn't happen all that often. So yesterday, the market opened down 2.6% on the S&P 500, and most people thought, okay, it's going to be another really down day. But what happened? By the end of the trading day, the market closed up 1.5%. So the bears were overtaken by the bulls, and the market closed with a very strong bullish candle after having touched the 13.7% drawdown from peak mark. Now, why is this level significant? 13.7% level, which is the drawdown from the peak. Well, if you take a look at the last 24 corrections that happened in the last 47 years, and remember, a correction is defined as the market falling between 10 to 20%. Now again, some of them were deeper, some of them were more shallow, but if you take the average of the last 24 corrections, you get an average of 13.7%. This tells us that 13.7% is the average bottom of most market corrections that of course don't turn into a bear market. And like I said, I don't see a bear market happening this year at least. All right, so that's the first thing to think about. Now, the second thing is we made a second low yesterday, taking out the previous swing low over here. Now, what pattern is this called? I've mentioned this pattern many times. This is called a double bottom pattern. It's a double bottom pattern that forces out stop losses placed by retail traders at the low of the previous swing low, right? So see, many traders, they would think that, okay, this is the low, I'm gonna go long over here. All right, so now at that time, yes, I did say that, hey, this looks like the end of the correction, the bull is back, and of course the bull got whacked back down, right? No one can call the absolute bottom all the time. I can't, right? So what happens is a lot of people, they saw, okay, the market's going up, so they go long over here. They place stop losses over here. Now, market makers, they use the news as an excuse, if they can, to drive the price down again. Of course, the very convenient news is, of course, Russia and Ukraine now, right? Previously, it was inflation. Before there was COVID. Now it's like Russia and Ukraine. So market makers force the price down. And what do? They force it down enough to hit the stop losses of retail traders, forcing retail traders to sell their stock once their stop losses are hit. Now think about it. When retail traders sell their stock, who buys the stock? Did you know that 80% of the time, the person buying from you is a market maker. The person selling to you is a market maker. So when retail traders sell at this price, market makers are buying, they're accumulating stock. And once they accumulate enough stock after taking out stop losses, they are then incentivized to move the market back up. So this double bottom taking out stop pattern is a pretty powerful bullish reversal signal. In addition, if you take a look at some of the indicators that measure the market, right? So for example, you've got the very famous Williams percentage R indicator, and you can see that during this recent low, the indicator shows an oversold condition as well. If you look at Bollinger Bands, we pierce the lower Bollinger Band as well. So everything is suggesting that markets are oversold. It's a double bottom pattern right at the average bottom of most corrections. So based on all these confluence of patterns that we are seeing, could this be the market bottom? Maybe. Now remember that no one can predict the bottom of any correction with 100% accuracy. No one can see the future. All we can do is to take a look at the probability of a bottom, the probability of a reversal. So whether you're an investor or trader, all you have are probabilities. That's it. And all you need are probabilities. You don't have to be right 100% in order to make money in the markets. Why? So let me give you an example from an investing perspective. Now, if you are, for example, an investor, you're investing in fundamentally good businesses. So fundamentally good businesses, when they drop, is not a falling knife. It's a bouncing rubber ball, because eventually it will hit bottom and bounce up even higher because it's a fundamentally good business, all right? Now, so for example, let's imagine that this is a fundamentally good stock like Microsoft or Adobe or Google, Alphabet, for example. And it's going up, and it makes a correction, right? And so you have got a bullish signal over here, and you say, okay, there's a high probability that this is the bottom. What do? Do you go all in as an investor and buy, and let's say you want to buy 100 shares. Do you buy 100 shares right here? Of course not. As an investor, you always want to average in your position because you never know, it could go lower, right? So out of 100 shares, for example, you may want to buy, say, 33 shares first, which is 1/3 of your planned position. Now, if this really is the bottom and it goes up, okay, fine. You've got a 1/3 position in. And then in the next correction, guess what? You add another 1/3 position, another 1/3, and you average in till you have got a full position. Of course, provided that the stock is undervalued as you keep averaging in. Okay? Now, what if after you entered the first time over here, it went lower? So, yep, there was a probability it was a reversal, but the reversal failed and it went down. No worries. What you do is once it drops to the second support level that you identify, you buy another 1/3 position, right? So we call this averaging down. So as an investor, you could average down or average up. It doesn't matter. The point is that these bullish signals give us the probability of when it's going to reverse. So as long as you average down when you have a signal like that, you will get a pretty good average price. And over time, as the price increases, as the stock appreciates, you will be very, very profitable. So that is the perspective of an investor. So again, as an investor, you don't have to predict the exact bottom because no one can. You just have to identify a potential reversal. You add shares. If it goes lower, you add more. You average your position. It's not a falling knife, it's a bouncing ball. You'll go higher eventually. Now, how about from a trading perspective? Trading is different because in trading, sometimes you may trade stocks that are more speculative. They may not be fundamentally profitable, right? So they may not go up in the future, right? They may keep dropping. It's a falling knife. So for trading, what do? Trading is different. So in trading, you identify a stock that drops, and again, you identify, hey, this is a potential reversal. What do in trading? Trading is different, right? Trading is like a one-night stand. So you enter the trade when you see a confirmation of that reversal. And I'll talk more about how to identify confirmations in a while. But in trading, you got to put a stop loss. Why? Because if the reversal fails, what happens? You get stopped out and you lose a small percentage of your capital. We call that 1R. R represents the risk you're taking. But if it does succeed, you make more than your 1R risk. You make, for example, a 2R or a 3R profit potential. So in trading, you're always risking $1 to make $2, for example, or you're risking $1 to make $3. Now, again, in trading, do you have to be right all the time? Must you pick every single bottom? No. In trading, remember, as long as you're right more than half the time, you're very profitable because you lose less when you're wrong, you make more when you're right because you're risking $1 to make $2, you're risking $1 to make $3. So again, the point is this: we just need these bullish reversal patterns to either take a trade and take an investment. So because I look at this as a potential reversal and a potential bottom, what's my game plan? So my game plan tonight is, if the market can trade above the high of this candle, if it can trade above the high of this candle, I will start to cautiously take some trades, long trades, right? At the same time, I'll cautiously add more shares to my investments. And if by the end of today's trading session, by the end of Friday's trading session, if the market can close above the high of the bullish candle, that would increase the probability even more. And so next week, I'll probably take more aggressive long trades and add even more to my investment positions. Now, this would be looking at the daily time frame. Now, if you look at a weekly time frame, do you also see a potential bullish reversal pattern? Yep. What you can see from the weekly time frame is a potential bullish pin bar forming again as a double bottom pattern. Now, some of you may say, hey, but it's a red candle. How is it a bullish candle? Yes, it is. Remember, when you look at bullish pin bars, the color of the body doesn't matter. It can be a red candle or white candle because the body is a small candle body. What matters is the pattern. You want to see a small candle body with a long lower shadow. That constitutes a bullish reversal, or rather a bullish pin bar reversal pattern, regardless of the color of the candle. But on the weekly candles, the pattern is not yet confirmed. Why? Because the candle closes at the end of the week. So we still have one more day, which is Friday. So we never know how Friday will close. So if today's market, which is Friday, if we can close as a bullish pin bar pattern, then this bullish reversal will also be confirmed on the weekly time frame. So all eyes on what happens today. Are we going to close as a bullish pin bar on the weekly time frame? And on the daily candles, can we close above the high of yesterday's bullish candle? If we can, there's a pretty high chance we're going to see a strong rally back up. So what are some potential trades I may take on individual stocks? So I'll look at individual stocks and to ensure that they exhibit a bullish reversal pattern as well on strong support. So let me give you an example, right? So I'm looking at a couple of trades today. One of them, just one of them, is Adobe. Now, if you take a look at Adobe, you can see that there is a pretty strong level of support over here that's been tested multiple times on the weekly time frame. So sure enough, the market, well, Adobe's price has gone down and it's right at this support level over here. And again, you can see it's oversold on the indicators, on the Bollinger Bands, on the stochastics, the Williams R. And again, if you zoom down to the daily candles, you can see that it closed as a bullish engulfing pattern. So based on this technical setup, we can see that, hey, if Adobe can trade above the high of yesterday's candle, then we've got a pretty good chance of Adobe rallying all the way up, at least back to this level of resistance. And maybe it may even break that level, who knows? But it should rally to at least about 522 with high probability. So how could I take this trade of Adobe? Well, of course, I could just trade the shares outright. I could just place a buy order over here so that if the price exceeds the high of this candle, I'll just buy in and I'll put a stop loss over here. So if I'm buying at this price, I'm putting a stop loss here. What is this called? This is my risk per share, or my 1R, right? So if I'm risking 1R, I want to ideally make about 2R or maybe 1.5R, right? Somewhere over there, right? So this is where I will take profit, okay? But once the price goes up and hits this resistance, right, I may shift my stop loss above the entry so that if it comes back down, I get a break-even trade. So this is an example of how I would set up a trade with Adobe using stocks. But I'd like to trade options, right? So There are many ways I could trade options on this. I could use a bull call spread. I could use a bullish synthetic spread. I could also use a bull put spread. Another example would be, for example, Salesforce. If you take a look at Salesforce, you can see, again, a bullish engulfing pattern forming yesterday with indicators showing oversold conditions. And if you zoom out to the weekly candles, you would see that this 200 moving average on weekly candles has been a very strong support on the longer term time frame, right? So it hit the 200 and it bounced off that. And right now it is right at this 200 moving average. So is there a chance that this again could be a reversal for Salesforce? Again, there's no guarantees in trading, but this looks like a high probability trade where again you risk $1 to make $2 or risk $1 to make $3 using stocks or options. But for Salesforce, I probably will not take a trade on Salesforce. I would invest in Salesforce as a long-term investment, but I wouldn't take a trade for the short term. Why? Because earnings are coming up. That's right. The company is going to be announcing earnings on the 1st of March. And one of my rules is I never take a trade just before earnings. I never hold a trade through earnings, because in earnings, anything could happen. It could gap up, it could gap down, and it would mess up the technical setup of the trade. But I would invest in Salesforce because in investing, it's a long game and it's a great company. So even if it gaps down in the short term, I'm cool with that for an investment. All right, so that's how I read the markets. And I know, some people will say, but Adam, aren't you considering the fact that Russia is in the middle of a war with Ukraine? They're now, going to overtake the capital and stuff like that. Aren't you concerned about that? One of the things that I've learned for the last 30 years in the markets is this, that when I make investment and trading decisions, it's always based on the technical setup of the stock or the fundamentals of the business. I do not take into account the macroeconomic news, all right? Because a lot of it that you read on the media, a lot of it is manipulated, a lot of it is skewed. And like I said, very often the market goes up and down not because of news. It is driven up and down because of algos and market makers that use the news as an excuse to justify the market movement. So I focus purely on the price movement, on the stock fundamentals. I ignore what's happening out there, because remember the lesson from the COVID crash, even when the economy is in shit, even when the economy is down the drain, the market can still go up. Even if Russia is on an all-out war with Ukraine, the market can still go up. So don't get distracted by the noise around you. Focus on the market price action itself. So we can't predict what Putin's going to do next. So there's no point focusing on something that we can't predict, we can't control. We focus on the price action. So with that, let's just send our best to the people of Ukraine, hoping for their safety, hoping that things would work out in the end. All right, so this is Adam signing off from my vacation in Tasmania, taking some time off to share with you about what's happening in the markets. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.